Good day, fellow investors. It's an honor for me to present here at the Value Investing Summit, and I'm going to try to give you as much value as possible so that you invite me back next year when I hope it will be in person and I get to meet you all. The topic that I want to discuss today is that value investing usually doesn't do great or compared to other in bull markets, exuberant markets like we have seen over the last 12 years, when someone even called value investing to be dead. However, value investing makes the difference in a declining, bad, sluggish market, even in a sideways market. And that's the topic of today, as it is very likely that the next 10 years will be a wavy market. It is time to really dig into value investing, focus on risk, focus on the topics we'll discuss today, the steps to have a clear value investing strategy, and then reach your investment goals over the next decade, no matter what happens with the market. Because, as they say, a rising tide lifts all boats, and over the last decades, we have seen declining interest rates and then a long period of zero interest rates, but now things have shifted, and for the first time, the top now is higher than the previous top, and therefore we might see different things when it comes to investing going forward. And I'll discuss 4 key factors when it comes to value investing, where we'll first define value investing, the correct definition that you can apply strategically when it comes to investing. Then we're going to discuss the risks, the market, everything, because value investing is about first risk, then everything else comes easy. We're going to search for value today and then discuss how to be ready to take advantage of that value. Because when it comes to investing, in a period higher inflation like it's likely to be in the next decade, the S&P 500 or the market did nothing from 1969 to 1982. 15 years of nothing. But the bottom 20% of lowest P/E ratio, lowest price to book value, and highest dividend yield did in the same period a 10x. That's a huge difference, and that's the key explanation of how value investing, and especially when value investing, works. And the key is that you are ready when things happen, that you know what to do, how to do it, how to apply the strategy to get to that 10x compared to whatever the market does. And that's my goal also for this presentation, to give you strategic value so that you know what to do no matter what happens next. Before we start, for those that don't know me, let me just introduce myself quickly and then let's dig into the content. My name is Sven Karlin. I am value investing with Sven Karlin on YouTube, so you can just search for more content about value investing. I just did the complete margin of safety chapter by chapter summary. So if you want more value, you can always look there for more value investing. And if you want deeper insight, real research reports, investment thesis on opportunities, my portfolios, you can check either my separate investment thesis or a complete overview, coverage, stocks, portfolios on my research platform, which is where I show the details of what I do and what I think of the market. There are many satisfied value investors there, so I hope I am also giving value there. And also you can check my book Modern Value Investing. It's a nice read about how to look at things a little bit different, because also value investing has changed over time. If you have any questions, just send me an email, investwithsven@gmail.com. Now let's start with the content, and let's start with properly defining value investing. Because nowadays everyone calls themselves a value investor, even the most speculative, greedy managers there say they are now deep value or something. So value is the most misused investing world out there. Because yes, we have the Graham definition of value: low price to earnings ratio, low price to book ratio, and in the book value you find that cigar butt that has one left puff in it. And that was the definition of value investing 70 years ago when Benjamin Graham started with the, let's say, clarification of what value investing is. However, when it comes to today, to modern value investing, you must keep in mind that a low P/E ratio or low price to book usually says that the market expects a bit negative things. You have to keep in mind the business cycle and that stock prices usually show what the market expects and what the business will do next. But the price earnings ratio and all the ratios show what happened in the past. So this is a metric that we have to adjust to a specific situation, but not as easily used as it was the case with Benjamin Graham. If we go to the newer definition of value investing, if we go to Investopedia, it's an investment strategy that involves buying stocks that appear underpriced relative to their intrinsic value. Now, we go to the next step. Okay, what is intrinsic value? The simple calculation is that intrinsic value is the present value of all the future cash flows you are going to get from that investment. However, here we have another issue when it comes to investing. We have to estimate the future, and we also need to know at what rate to discount to get to the present value. So there are always issues with the correct definition, but I'm going to try to give you one that's much easier. There is another definition that simply paints everything with the value investment brush, where you say everything that is intelligent investing is value investing. Of course, that's easy, but that doesn't help me as an investor. Now, when it comes to defining and something that you can really apply and take home and use when it comes to your investing, I want to make a clear definition and separation of what value investors usually do and how they gain value from the market. Because when it comes to investing today, everything is about the market. All the news, at least 99% of the news, is all about the market. And that is logical because over the last 40 years, we have enjoyed a secular bull market in stocks. Practically, stocks just went up, in this case, the S&P 500, but mostly investments in financial assets have done really, really well over the last 40 years, except last year, but okay, that's something to see how it will develop over time. However, why did stocks just go up over the last 40 years? The answer is very simple, because interest rates just went down, and as Warren Buffett says, everything is off interest rates when it comes to investing. So if interest rates go down, financial asset prices and values go up. If interest rates go up, financial assets go down. That is the simple truth of investing, and that might change. The environment we have enjoyed the last 40 years might change. Thus, you have to think differently about everything. Because if a rising tide lifts all boats, a declining tide shows who has been swimming naked, and that's not what you want when it comes to investing. Plus, when it comes to predictions, just look at this. It's insane how big is the focus on the market, but that does sell. Not with value investors, but with 99% of the other population. For example, Goldman had a 2022 and 2022 target for the S&P 500 at 5,100 points. Then already in February they lowered it, and now of course they lowered it to the level that it is now of 4,000. I don't know how much it will be when you watch this, but likely not much far from there. So we have predictions, and the only reality, as we have seen with this market prediction by Goldman and every other market predictor, it is impossible to predict the market. Nobody knows where the market will be in 2, 5 years, 6 months. Nobody knows. So if nobody knows where the market will go, Some think it's uncertain, it's risky, it's this or that. But I, on the other hand, think that is the key opportunity that we have to differentiate ourselves from everyone else in the market. And therefore, I want to give you a definition that will likely make you think differently about investing and about what investing is. I believe that value investing, especially for 2023 and the next 10 years, is investing in a way so that whatever the market does, you do okay as an investor over the next decade. The key for us is to separate ourselves as investors from the market. Yes, the last 40 years, everyone putting a cent into the market made money, got richer and richer because interest rates went down. Over the next 10 years, interest rates, inflation might go up, which means that only real investing will matter and will lead to great returns. So the key is to forget about the market and focus on what you are investing in. No matter what the market does, you want to do well. And the similar period to what we might expect over the next 10 years was the period from 1964 to 1982. Over 15 years, 20 years, the stock market didn't do much, but it wasn't flat. It was ups and downs, ups and downs, ups and downs, and value investors did really well because we have the right strategy of buying low and selling high instead of what usually investors do, which is buying high and selling low. And this is also explained in the most important chart you might see out there for understanding investing. And this is the annualized returns by asset class over the last 20 years by JP Morgan. If you look at the market did its thing, returned 9.5% over time. However, if we watch the average investor, and what the average investor did is 3.6. So 1/3 of the market's return is what investors got out of the market because of the wrong investment strategy. Of course, not a value investment strategy. So by focusing on the business, the investment, by focusing on things that you do well, no matter what the market does, you become a value investor and you are set to have great investment returns over the next decade, no matter what the market does. That is the goal of value investors, and that allows for compounding over the long term, and that is why Buffett is Buffett. That's why Seth Klarman is Seth Klarman, because no matter what the market does or did, they will do their own thing. They will invest so that they allow for long-term compounding. Now that we have defined value investing and how it should work over the next decade, we go into the next core component of value investing that actually allows you to invest in a way that whatever the market does, you do well, and that is focusing on risk. Because if you focus on risk first, you try to eliminate that downside that's always there. And by eliminating the downside, you allow for upside no matter what happens to the market. Because as Seth Klarman titled his book Margin of Safety, the core component of margin of safety is to eliminate risk. No matter what happens, you have a margin of safety when it comes to your investment, which means that the price is already so low that the worst thing has been priced in, and you take advantage of that market irrationality of selling something for the wrong reasons, and then you simply buy and wait for the value to unlock itself over time. Not relevant to the market. And by eliminating risk, all that's left is upside. That is the second principle of value investing. How to do that? Always invert, and before investing into anything, ask yourself, what can possibly go wrong? And if you start thinking, okay, what can go wrong, you eliminate 99% of things that can actually go wrong. And as Munger says, you don't do stupid things. Over the long term, it's much more important for a portfolio to not have stupidity in it than whatever crazy return one might get from whatever crazy speculative investment. Because sooner or later risks materialize. Therefore, you need to minimize those to allow for compounding. For example, let's discuss a little bit about the general investing risks. If we look at the S&P 500 dividend yield, it is currently at 1.65%. That is, for me, extremely low. Some will say buyback, some will say this, but irrelevant. If you invest now in the S&P 500, this is the dividend you got. If you look at historical means and medians, you see that it is much, much higher. What happens to the S&P 500 if this required dividend yield doubles and goes to, let's say, 3.2 or 3.3%? So if all else equal, the dividend yield doubles, then the S&P 500 falls 50% if the required dividend yield doubles, and we are soon to 2K. That is the risk of what can go wrong for the S&P 500. And this also discusses the main assumption, but by those investing now in the S&P 500, that assume after 40 years of lower interest rates and inflated financial assets that all will remain as is, which is a risky assumption to make. It is possible that it remains as is and stocks just keep going higher and higher, but it is also possible that dividend yields, expected dividend yields, as it was the case in the 60s, that were stable and low, suddenly over time, only later in the inflationary decade, go higher as inflation creeps and everything, and then you have a normal 50% decline, especially in real terms. So that's the risk of investing in something like the S&P 500 now, and you have to be aware of that as a value investor. And then you say, okay, that's the risk, compare it to other risk and reward opportunities, and that's how you structure your portfolio over time. You wait for the right opportunity at the right time, at the right moment to invest with low risk for good long-term returns. Plus, we are looking at inflation that is likely not going to go away. And if we compare again the current situation with the early 1970s, late 1960s, we see that stocks haven't gone anywhere for practically 15 years in real returns. This is dividends included. So if you invested 100 in 1969, by the end of 1982, you would have dividends included in real purchasing power $92. So an 8% cumulative return over 15 years. That is not what you expect, but with value investing, you can do much, much better. As we have discussed, while the S&P 500 did zero, a value investment, easy, simple value investing strategy did 10x over the same period of time. Now, I'm not saying that value investing will do again the same over the next 10 years, but we have to focus on how to protect ourselves from whatever happens with inflation, with interest rates, and get to a good return. There is nominal and real investing. We have to get a return above inflation. If not, it's better to spend that money. And let's now look at opportunities out there. The S&P 500 has a low dividend yield. Let's now switch to the Hong Kong index that has a higher dividend yield, and let's see what can go wrong there. And at the end of the video, we'll discuss, okay, even if it goes wrong, what to do as an investor, which is then again part of the strategy that should help you make money, invest well, no matter what happens next. So if I go to the Hong Kong Stock Exchange, the dividend yields there are significantly higher than what the S&P 500 offers. We are talking 6%, 5, 4, 7, 4. So on average 5%, which is 3 times what the S&P 500 offers. Of course, we also have to look at the businesses there that are utilities, banks, utilities, telecoms, diversified retail. So not really great growth companies like those in the S&P 500, which then also represents a risk. And you have to see what kind of risks you want to take or what kind of security of investing in something where no matter what happens, you get your dividend, you compound it over time, and then that is your return you are happy with. If we just look at CK Holdings, if I just take a look at what is the risk there, I see that there is significant debt, and then you say, okay, the average cost of debt now for them is extremely low with interest rates going higher. This could then be over the next 5 years from 1.8 to 5%, and then you have to calculate how will that impact their balance sheet and profitability. For now, the market doesn't really like what's going on, and especially as interest rates started to go up, the stock has declined significantly, but the dividend yield is still there, the price earnings ratio is extremely low, and now you have to ask whether investing in this, no matter what the market does, will do okay. At some price, every investment is a great investment, but the lower the price is, of course, the higher is your return and the better is the margin of safety. So what I'm saying is to ask yourself, in this case, how does owning this feel for me and how do I go about owning this over the long term, no matter what happens to the market? How happy am I with the dividend yield, with the businesses, with the growth, with the owners there, Li Ka-shing, and their strategy, their history? And then when you know a business well, then you can answer the question, okay, will I do well no matter what the market does in the future? Looking further into the risks, if we take this slide from GMO, we see that 7-year asset class real returns forecasts are pretty skewed to emerging markets and emerging value, as we have shown with the Hong Kong Stock Exchange, for example, and we'll do more examples in a second. International US returns, expected returns are actually negative, plus we have their lower economic growth, high debt burdens that also burdens Europe, for example. But this is top-down investing, which is not value investing, but you might find some indications of where to look for investment opportunities. Of course, bonds with inflation, you're likely going to lose money no matter what, and you want as an investor to seek for more. Again, value investing is bottom-up investing. You go through the whole list and you find those investments that will do well. But I just want to summarize things better. Take a top-down approach now at that risk perspective, risks first, to also know what to avoid when it comes to those individual businesses. Because if you look at the federal finances of the US, you can see that each year the government is just borrowing, 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 and borrowing, and that the government deficits are expected to be constant forever. The plan is that a government can borrow forever, the same is for Europe and most developed countries out there, no matter the consequences. However, there is one consequence that sooner or later comes, and that is inflation. For 20 years, the borrowing, and especially over the last 10 years, the borrowing was possible, but then something triggers inflation, which is then structural and therefore hard to resolve. And yes, it goes up and down till you don't really resolve it with a big recession, and that's something we have to expect ahead, but also expect a lot of volatility because it's not that easy to do. That's also something you have to think about. Whatever happens to inflation, whether it will be on average 8% over the next 10 years, or 4%, or 2%, whatever happens there, you need to know that your investment offers a margin of safety no matter what happens. Other issues could be sectoral, structural issues. You want to invest in things with a tailwind, but always keep in mind at a fair price. So, energy, it is in transition. They say that fossil fuels are going down, even if consumption doesn't say that, and that renewables are going up. Now you have to see what is the lowest risk investment, and then that depends on the price of what you're paying for the investment. But you have to also think about, where does my business stand in the long term development of things? The security is that the Fed and central banks will do whatever it takes to keep the economy alive, which means that at every hiccup, they are going to lower rates no matter what happens to the currency, and therefore also print more money. So, next crisis, next recession, what are they going to do? They're going to keep printing, which leads to the fact that keeping cash is certain to lose your money. Even investing in bonds will give you negative real returns. So, the only option left is to look for value investments so that no matter what happens, you do well. Huge risk in the global bond market that has exploded as interest rates went down, as central banks printed money. This is insane that the 2007-8 financial crisis has been solved by issuing more debt, and the level of debt in the world now is double what it was. So that is again a risk to keep in mind, so that no matter what do governments, currencies, your business does well. On positive long-term structural trends, you might look at what is going on with the middle class over the world, no matter what the short-term trends are, and then look at investments that can take advantage of the 1.5 billion people that are entering or will enter the middle class in the next decade. Also, you can look at commodities that are usually cyclical, and you have to invest in those when nobody wants to touch commodities. Now, we are still not yet there, but this is, for example, something that I follow over time, and you can always dig deeper into what I do if you're interested to follow and take advantage of these cycles, again, not related to the market. Then we also have geopolitical risks that are there. Nobody knows what will happen, but again, you have to think about these risks and see that first you have to sleep well at night, and then if things really go wrong, how does that affect you? Because there is one certainty: with inflation higher and cash returns nowhere, you have to invest to protect your wealth, but you have to do it smartly. And now, I hope I have scared you, because being scared is the core feeling of value investments, because you don't want to lose your money. And if you have such an attitude, then compounding is what's left on the other side. But you have to do it properly. And I have said it's not top down, it's bottom up. So you go through lists and you look for those investments that might fit you. For example, if we look at low price to earnings ratios, China is now the lowest, emerging markets, Europe is also offering opportunities, but even the US is much, much cheaper. Google at the price earnings ratio of 20 is already something to consider if you like that as an investment, and we'll discuss how to do that later in the strategy part. So, as a value investor, what do? You just go through one by one of these businesses listed, in this case in Singapore. There is a lot, and you just seek for those few that fit your investment strategy, your investment requirements, and your risk tolerance for your rewards. There is nothing wrong with going one by one. And a stock that I know here and I have been looking a little bit is Wilmar, and we'll just dig into a little bit deeper there. So if we take a look at Wilmar, it looks good. The price earnings ratio is in the single digits. The dividend yield is there. The stock didn't do much over the last decade, but then again, you have to compare the price now, the business now, to what is the future outlook, and then see whether it is value for you or not. If I look at the revenues are inflated a little bit because of inflation, and that is again something protective. You always think, okay, whatever happens with the world with inflation, am I protected? And with food, you are protecting yourself from that food inflation. They have growing revenues, and they even increase the dividend in line with the growth of revenues, and net profits went even higher. If you look at the business, they really made a lot of gains in the plantation and sugar milling. So you have to then understand, okay, sugar prices, this cycle there, the potential ups and downs, and at what price, no matter where the cyclical sugar prices go in the short term, you are happy owning this as a business. Wilmar, food products, palm oil, sugar, and other things, owned also by Archer Daniel Midlands. That's also a very interesting food company. Or it was when the price was much, much lower. You look at cash flows, they were profitable, of course, with high investments, with high capital expenditures into growth and everything. You have to check when this is going to turn into cash flows to calculate your intrinsic value and then to compare it to the price. The debt isn't as high. These are trading companies also, so there is always debt for working capital, but the debt there isn't as high as others, so it shouldn't be affected too much by what's going on with interest rates. And if we look at the business outlook, prices of foods are expected to go lower a little bit, but not that much. And then you always know that food prices will go up and down, and that's also something that's going to impact the company. But as a long-term investor, you have to invest in businesses that when and where, no matter what happens, you do well. If we look at revenue, yes, revenues are up, but also sales volumes are up, which also tells me the business is growing. The plan is to grow further. And then you say, Sven, yes, but this is just a boring food business. It will not make me rich fast. That's exactly what this kind of business is. But it is an essential business, and it grows slowly but steadily. It has doubled revenues, almost doubled over the last 5 years. So if that continues, the dividend will go higher and higher. The net income of the company will be higher and higher. And then you think, okay, if the business is better, bigger, and bigger over time, that at a certain price compared to other opportunities should be a great investment. I have no idea where palm oil, sugar prices will go. No idea. So I have to look at, okay, at what price Wilmar gives me a margin of safety so that no matter what happens to sugar, palm, over how long, I get a good long term return. And we'll discuss later, if it goes lower, I'm happy to buy more. That is the value investment strategy. Am I happy owning Wilmar as an owner? And if the answer is yes, then that's investing, that's value investing. To answer the boring question, let's go to Buffett. When Jeff Bezos asked Warren, your style of investing is so simple, why doesn't everyone just copy you? Because nobody wants to get rich slowly. Remember the chart we showed at the beginning? the market getting rich slowly versus the average investor getting rich fast. And if you want to get rich slowly, I've just done a complete summary of the Margin of Safety investment book by Seth Klarman, chapter by chapter. It's a bit expensive book to buy it online, so you can watch the videos and then dig deeper into the core value investing things. So I hope this will give you much more value and deeper insights into what I have discussed today. It's a core book written a long time ago, but this is everything you need to know when it comes to value investing. And feel free, I hope we can share a link here to the value investing summary playlist. That's the essence of investing for me. And then you can check chapter by chapter what really matters when it comes to investing and how to approach this investment strategy so that you are not the average investor, not the market, but even better. Which leads us to the psychological part of investing: how to buy, when to buy, and how to be ready for whatever the market throws at you. And I want to go deeper into chapter 13, which is an essential part of strategy: how to buy and when to sell a stock around that intrinsic value, because value investing is about buying low and selling high. Why selling high? Because if just the price changes but nothing else changed, then the risk is much higher and the return is much lower. But also, knowing value investing will give you the courage to buy here when everyone else is selling, and then to average down and take even more advantage of the market's short-term focus and irrationality. And if you just look at the market and what the market is doing, if you just look at how exuberant it gets in a year and how negative and pessimistic it gets constantly, you know that there will be many opportunities for those who are seeking those and for those who are willing to buy when everyone else is selling. Of course, when you just look at the market, it's hard to predict and time the correct time to purchase, but with value investing, you buy when it is a bargain with low risk. Nobody knows whether the current inflation is here to stay or not, so we have to invest at low prices so that no matter what happens to inflation, our returns are okay. And to invest into something and you start buying when you're already happy owning it, and then you never know what can happen to the market. If it goes 50% lower, you buy more. If you don't have cash, you have dividends that sooner or later arrive that allow you to buy more. Plus, the company can, if it's a good company, do buybacks and then increase your wealth over time. And the core is that you also know the business. Wilmar, again, cultivation and milling of palm oil and sugarcane, processing, packaging, and food, very stable business, has been around for a while. And then again, at what price it fits you, no matter what. This is not investment advice, this is just an example. And then you compare such researches to as many opportunities as you have out there. To dig deeper into buying and selling, how to buy but being an investor. Of course, you are affected only by price, and you must not be affected by fear or greed. The problem with investors is that here they believe stocks will only go up and they have fear of missing out who knows what. But when stocks are lower, they believe that the world is going to end, and they don't see that when stocks are down 25%, it is cheaper, therefore their returns will be higher. So as a value investor, the key is that you are ready to average down, knowing from the moment you buy something that if it goes down 25%, you have to say, okay, I'm buying this now. If it goes down, I'm willing to buy more. then you know it is a value investment. If you are not willing to buy more when something goes down, then you are speculating, you are in the wrong game, not investing. So keep in mind, ask yourself, am I willing to buy more when it goes down? I always tell people Google is a much better buy here than it was here at 150, but of course it was an even better buy at 50 than it is now. It's simply a function of price. To buy more, you have to see about your income, your personal financial situation, how to get to the cash to buy more. Will you just wait for dividends, which is also a great strategy, but you have to have that mindset of if the stock goes down, that's a good thing to me. That is the value investing mindset. But that's buying. Perhaps even more important and more difficult is selling, which is the hardest decision of all, because as a value investor, you try to buy below intrinsic value, your intrinsic value, and then you try to sell when the risk is higher and the returns are lower. You might also sell when it hits intrinsic value and then buy something else that is underpriced. It is a constant comparative exercise, and you're always comparing current holdings with other risk and reward opportunities, owning businesses no matter what happens to the market. Of course, this is very correlated with your emotions, and you have to set those aside and know that whatever happens with the market, you do well, and when you can do that, you are a value investor. To quote Seth Klarman, he always, like Charlie Munger, likes to invert things. If you don't look for a margin of safety and then sell when the risk is higher, what is your alternative? Just watching stock prices and following the market, and we have already seen how doing that is not really leading to great returns, because on average investors do really bad. So the process is to do research, to find those undervalued investments that you like for your portfolio. Then when those or give you dividends or materialize in value, you turn them again into cash, and then again you lower your risk by selling the overpriced and buying underpriced things. The focus of value investing is, of course, risk. That is the key, managing the downside first, and then the upside usually take care of itself. And that's what I want to sell. When it comes to buying and selling, nobody can predict the future, but you need to be mentally ready for whatever can happen. If the market crashes 50%, emerging markets value, whatever you own, will crash to likely, possibly even more. That is the best opportunity for you to accumulate wealth, and you hope stocks stay down for a decade and allow you to accumulate as much as you can over the long term. That is value investing. Let's just take Apple as Buffett's favorite holdings. He started buying here in 2016 and spent his 100 billion on the position. If the stock would still be at the same level, then he could own not just 5.4% of Apple, but 10, 15% of the company. That over the long term would give him more wealth. So the key is to be happy when something is cheaper, when something goes down. When it goes up, of course, realize the value. You're not Warren Buffett with billions that you cannot close a position and then buy something else. If this happens and the fundamentals stay the same, Apple has significantly increased earnings, so you must follow that intrinsic value line and see where it leads you. I hope you enjoyed this. Send me an email if you have any questions. Check what I do, Sven Karlin, online. Just type it into Google or YouTube and you will find me. Hope you enjoyed this, and I really hope to see you in person next year. Thanks for watching, and I'll see you around.